Okay, so you've given us some really interesting material to dig into today. We're looking at Part 4B of a professional code.
That's right. It's all about international independent standards specifically for assurance engagements.
Got it. So this is kind of our quick guide to the key ideas and maybe some specific examples from the documents.
Exactly. Think of it as hitting the highlights, and it covers quite a lot, assurance on things like KPIs, regulatory compliance,
Right.
value for money assessments, internal controls, even greenhouse gas statements or specific bits of financial statements.
Wow, okay. So a broad range. And independence is obviously key here for credibility.
Absolutely fundamental. Without it, the conclusions just don't carry the same weight. Trustworthiness is everything.
And that leads us to this conceptual framework for independence
Yeah.
you mentioned. I think we've seen similar ideas for audits and reviews.
We have, yeah. But Part 4B really applies that same structured thinking, identifying, evaluating, addressing threats across all these other types of assurance work.
Okay, so it's a consistent approach. Let's really get into the weeds then. Where do we start?
Well, let's start with the basics, the general principles. Independence, fundamentally, is tied to objectivity, being unbiased,
Right.
and also professional skepticism. That means having a questioning mind, not just accepting things at face value.
Makes sense.
So the code talks about two key aspects. First, independence of mind. That's your actual state of mind, allowing you to give an opinion without being influenced.
Okay, that's the internal part. What's the second?
The second is independence in appearance. This is crucial. It's about avoiding situations where someone reasonable, looking from the outside, might think your independence could be compromised.
Ah, right. So even if you feel objective, it has to look objective too. Like maybe don't go on lavish holidays paid for by the client CEO, even if you swear it won't affect your judgment.
Precisely. That's a perfect example. Perception really matters here. It's about maintaining public trust. And the framework isn't passive. Firms have to actively apply it, using Section 120 as the guide to manage these risks for every single assurance engagement.
So it's an active process, not just a background thought.
Definitely. And it's a responsibility shared by the firm as a whole and the individual accountants working on the engagement.
That dual responsibility seems important. Does the firm's overall quality system play into this?
Absolutely. The material mentions ISQM1, that's the standard on quality management. Firms need systems, policies, procedures specifically designed to uphold independence. It provides the structure.
Right, so the organization backs up the individual commitment. Okay, so this framework, you said identify, evaluate, address. Can you walk us through that process?
Sure. It's basically a three-step approach. First, you really need to identify all the specific facts and circumstances for that particular engagement. What's going on?
Okay, step one, understand the situation.
Step two, evaluate any potential threats to independence that arise from those facts. Then consider what actions or safeguards you could implement to reduce those threats.
So find the problem, think about solutions.
Exactly. But step three is the critical backstop. You have to recognize when a threat is just too significant. Sometimes, no safeguard is enough to bring it down to an acceptable level.
And in that case?
In that case, you have to decline the engagement, or if it's already started, you have to stop. It's a hard line.
Okay, that's clear. No compromise on fundamental independence. Let's move into Section 900 then. That's about applying this framework in practice.
Yeah, Section 900 gets more specific. It reminds us the whole point of an assurance engagement is to get enough good evidence to express a conclusion that boosts the confidence of the intended users about whatever subject matter information is being looked at.
And who counts as the assurance client? Is it always straightforward?
Good question. It's not always just one party. The code says the primary client is the responsible party, the one accountable for the subject matter. But it adds that in an attestation engagement where someone specifically takes responsibility for presenting the information, that party is also considered the assurance client for independence purposes.
Ah, okay. That's an important nuance. Now, there's a big point in here about not taking on management responsibilities. Why is that such a strict rule?
Oh, that's a huge one. Taking on management roles creates massive threats, mainly self-review, like how can you assure work you were responsible for doing?
Right. You can't really audit yourself effectively.
Exactly. And also management participation threats. If you're making management decisions, setting policy, hiring people, authorizing deals, controlling cash, you're just too embedded. You've crossed the line from assurer to manager. The document lists several examples of what counts.
Yeah, I see that. Things like setting strategic direction, hiring, firing, custody of assets. It seems clear, but I wonder, especially with smaller clients, if that line can get a bit blurry when you're just trying to be helpful.
It can be a challenge, definitely. That's why maintaining that clear distinction is so vital. You advise, you recommend, but management has to make the actual decisions and take responsibility.
Which means the client needs someone on their end who can take that responsibility, right?
Absolutely. Management has to designate someone internally, someone with the right skills, knowledge, experience to be responsible for the subject matter and oversee any services the firm provides, including the assurance itself.
Okay. And what if there are multiple responsible parties involved?
Yeah.
Like in a complex project?
Yeah, that happens. The guidance says the independence rules apply to each responsible party if their interest or relationship could pose a threat.
So you have to look at each one individually.
Pretty much. You assess the threat based on things like how important is the piece they're responsible for? Is there significant public interest? It requires careful judgment.
Got it. And this extends beyond just the direct client, doesn't it? What about network firms or related entities?
Yes, good point. You can't just look at your own firm's direct relationship. You have to consider the whole network. If another firm in your network has a relationship that threatens independence for your engagement, that's a problem.
Okay, so it's a wider view. Think about the whole group structure.
Exactly. The interconnectedness means potential threats can come from those related entities too.
And independence isn't just needed during the engagement, is it?
No, that's crucial. It needs to be maintained throughout the entire engagement period and during the period covered by the subject matter information itself.
Right, so if you're assuring last year's data, you needed to be independent last year too.
Precisely. It's a continuous requirement.
And communication seems key. Who needs to be kept in the loop?
Communication with those charged with governance, like the board or audit committee, is vital. They need to understand the firm's independence responsibilities, any threats identified, and the safeguards being applied. Transparency builds trust.
Okay. Now what if, despite best efforts, a breach happens? Something slips through.
It can happen. If a breach is discovered, the firm has to act fast. First, stop or suspend the engagement immediately, unless the breach is really minor, clearly insignificant.
Okay.
Then you have to evaluate how serious the breach was, what's the impact on objectivity, how might others see it.
Right.
Based on that evaluation, you figure out what actions are needed to address the situation. And critically, you have to document everything: the breach, the actions, the conclusions. Thorough documentation is essential.
That seems like a robust process for dealing with missteps. Okay, that covers the general application well. Should we move on to some of the specific threats mentioned, like fees, gifts, litigation?
Yeah, let's do that. Part 4B gets into quite a few specific scenarios. Fees are a big one, Section 905.
How can fees threaten independence? Seems straightforward, you get paid for work.
Well, it can create a self-interest threat. If a client represents a huge portion of your firm's total fees, you might subconsciously or even consciously be reluctant to issue a critical finding that could jeopardize that revenue stream.
Ah, the fee dependence issue.
Exactly. Or if fees are significantly overdue, it's almost like you've given the client a loan, which again creates a self-interest threat.
Okay.
And the code flat out prohibits contingent fees for assurance engagements. That means fees based on a specific outcome or result. That's just too direct a conflict.
Right, you can't have the fee depend on finding, say, no problems.
Definitely not. For fee dependence, potential safeguards might include having an independent reviewer check the work, someone not involved in the day-to-day engagement.
Okay, that makes sense. What about gifts and hospitality, Section 906? Seems minor, but maybe not.
It can be tricky. Accepting gifts or hospitality can create self-interest threats, feeling obligated, or familiarity threats, blurring professional lines, maybe even intimidation in some rare cases.
So a Patek Philippe watch from the CFO is probably out.
Yeah, that would be a definite red flag. The rule is generally that anything more than trivial and inconsequential is problematic. You have to consider the value, the frequency, the intent, and how it would look to an outsider. A coffee and a pastry. Probably fine. Regular expensive dinners, less so.
It's about that reasonable third-party perception again. Okay, Section 907, litigation. What if the firm and the client are suing each other?
Yeah, actual or even just threatened litigation creates obvious self-interest and intimidation threats. It puts the firm and client in an adversarial position.
Hmm.
Management might be less open, less willing to share information if they're in a legal battle with the assurance provider. And the firm clearly has a vested interest in the outcome of the lawsuit.
So it really damages that open, trusting relationship needed for assurance.
It really does. Safeguards might again involve bringing in an objective reviewer, but significant litigation often makes continuing the engagement impossible.
Okay, let's talk financial interest, Section 910. This seems like a really direct potential conflict.
It is. If the firm or a member of the assurance team or their immediate family holds a financial interest like shares or bonds in the assurance client, that's a major self-interest threat.
Right.
The code distinguishes between direct interests, owning shares directly, and indirect interests, like through a mutual fund. Direct interests are generally prohibited regardless of how small.
Regardless of materiality for direct interest.
For the firm itself or team members, yes, generally. For indirect interests, materiality does come into play. A tiny holding in a large diversified fund might be okay, but a significant indirect interest could still be a problem.
What about interest held through trusts or in a company that controls the client?
Those are covered too. Financial interests in a parent company can create threats. Holding interests as a trustee also requires careful evaluation. And if you accidentally inherit shares, for instance, you generally have to dispose of them promptly.
And it's not just the team member and their spouse or dependents,
Right.
right? It mentions close family too.
Correct. Close family, parents, siblings, non-dependent kids holding financial interests can also be a threat, depending on the closeness of the relationship and the significance of the holding. Safeguards might mean removing the team member from the engagement.
Okay, lots to consider there. What about loans and guarantees in Section 911?
Similar principle. Loans or guarantees between the firm or team members and the client create self-interest threats. You generally can't owe the client money or have them owe you money outside the normal course of business.
Are there exceptions, like a mortgage from a bank client?
Yes, there's an exception for loans from banks or similar institutions if they're made under normal lending procedures, terms, and conditions, and the loan isn't material to either the firm or the client. So a standard mortgage on market terms from a bank client is usually acceptable.
Got it. Moving on to business relationships, Section 920. Beyond just the assurance work.
Yeah, if the firm has a close business relationship with the client or its management, like a joint venture, or a significant supplier-customer relationship outside normal terms, that can create self-interest or intimidation threats.
But buying stuff from the client is okay sometimes.
Buying goods or services is generally fine if it's in the normal course of business and on arm's length terms, like the audit firm buying computers from a tech client at standard prices. The key is whether the relationship is significant enough to potentially influence behavior.
Okay, arm's length is the key phrase. Section 921 deals with family and personal relationships.
Right. These can create self-interest, familiarity, or intimidation threats. If an immediate family member, spouse, dependent of a team member, works for the client, especially in a key role,
That's a problem.
that's usually a significant threat, potentially insurmountable. For close family or close personal friends, it depends on their role at the client and the team member's role on the engagement. Safeguards often involve removing the team member or restructuring responsibilities.
Okay, what about people moving between the firm and the client? Section 922, recent service.
If someone who recently worked for the client in a senior role joins the assurance team, that can create self-interest or familiarity threats. How long ago did they leave? What was their role? What's their role now? All relevant questions.
And Section 923, serving as a director or officer. That sounds like a definite no-no.
Generally, yes. A partner or employee of the firm serving as a director or officer of an assurance client creates huge self-review and management participation threats. It's almost always prohibited. Even serving as company secretary is usually off limits due to the potential closeness to governance and management functions.
Right, clear conflict. Section 924 flips it employment with the client. What if a former partner goes to work for the client?
That can also create threats, familiarity, intimidation, self-interest, especially if they take a key role where they oversee the subject matter being assured or influence its preparation. The firm needs to assess the significance.
And what if a current team member starts job hunting with the client?
That immediately creates a self-interest threat. They might be tempted to go easy on the client to improve their job prospects. They usually need to be removed from the engagement team right away.
Makes sense. Okay, Section 940, long association. We touched on familiarity threats earlier,
Yeah, this specifically addresses the risk that comes from the same senior personnel working on an assurance engagement for a client for too long.
like the lead partner being there for 10 years.
Exactly. Over time, a very close relationship can develop. Professional skepticism might dull. You might become too trusting, too familiar. It can also create a self-interest threat, not wanting to jeopardize that long-standing relationship.
So rotation is the key safeguard here.
Rotation of key assurance partners and other senior team members after a set period is a common and often required safeguard. Or sometimes an independent review by someone external to the team. The goal is to bring a fresh perspective.
Okay. And finally, under specific threats, Section 950, providing non-assurance services. This seems like a minefield.
It definitely requires careful navigation. Providing other services, like consulting or tax advice, to an assurance client can create various threats.
Like,
Self-review is a big one. If you design a system, can you objectively assure it? Self-interest threats can arise if the non-assurance fees are very large. And crucially, management participation threats, you have to avoid making decisions for the client.
so the firm can provide some other services, but within strict limits.
Yes. The absolute prohibition is assuming management responsibilities. Beyond that, you have to evaluate the threats created by the specific non-assurance service. Is it related to the assurance subject matter? How significant is it? Safeguards often involve using completely separate teams with different reporting lines for the assurance and non-assurance work.
It sounds like constant vigilance is needed there.
Yeah.
Okay, we've covered a lot of specific threats. There was one last section you mentioned, Section 990, about reports with restricted use.
Right. This is a bit of a special case. Section 990 basically says that if an assurance report is specifically restricted in its use and distribution, meaning it's only for certain intended users who understand the context, then some of the independence requirements in Part 4B might be modified.
Modified how? Less strict.
Potentially, yes, but only if certain conditions are met. The firm has to communicate clearly with those intended users about which independence requirements have been modified, and those users have to understand and agree to the basis of the engagement.
So it's only for limited situations where everyone involved knows the score.
Exactly. It acknowledges that for certain non-public reports where the users have specific knowledge, a slightly different approach might be okay as long as there's full transparency.
Okay, got it. Wow, this has been a really thorough walkthrough of Part 4B. It feels like the core message is clear. Independence, both in mind and appearance, is non-negotiable for assurance.
Absolutely. And maintaining it relies on applying that conceptual framework, rigorously identify, evaluate, address, and being acutely aware of all these potential threats from fees, relationships, other services, and so on.
It's definitely not just a checklist exercise, is it? It requires real professional judgment.
Constant judgment, constant vigilance. That's the key.
So thinking about everything we've discussed and just how interconnected business and, personal lives are today, what do you think are the biggest emerging challenges? The things that are going to make maintaining this independence even trickier going forward?
That's a great question to ponder.
Yeah, something for our listeners to think about. Well, this has been incredibly insightful. As always, we're ready to tackle whatever other materials you bring our way next time. Thanks for joining this deep dive.
My pleasure.